So that's C corporations. S corporations, like I said, are, they're very popular. There are a lot of them out there. And so it is important to know about them. They're kind of a hybrid between partnership and a C corporation. But there are some restrictions on them. They used to be more popular when the tax rate was, when you didn't have the QBI deduction, they were more popular. Because the benefit of the S corporation, remember how partnerships, if you're a owner of a partnership, you can't receive a salary, right? It's guaranteed payment, subject to self-employment tax, all that stuff. Well, with an S corporation, you can receive a salary. And so the company can pay half of your Social Security and Medicare tax. There are some other benefits as well to the owner, because now you kind of have control, you have more control over how much income you're generating from this S corporation and how much is going to be subject to self-employment tax. The rest of the income, so the only income that is subject to Social Security and Medicare tax is the amount that you take in wages. All the other income on that K1, and you would get a K1 with an S corp, all the other income is not subject to Social Security and Medicare tax. Whereas with a partnership, remember, all of that income was subject to self-employment income, Social Security and Medicare tax. So it was a way for businesses to, or for owners to avoid that additional Social Security and Medicare tax. Now, one of the IRS was aware of the abuse that could happen, because, you know, maybe a business owner would provide services to their S corporation, but then they wouldn't take a salary. The IRS could come in and say, they'd take a distribution instead of a salary. The IRS could come in and say, no, that's really a salary. You're only doing this to avoid taxes. So they could go in and change that, and so they're aware of all that. But with the new tax law and the QBI, it sort of reduced some of the need for that. But I mean, there's still a very popular form of business organization. Actually, I shouldn't say business. They're not really a business organization, because an S corporation could be, well, they have to be a corporation. So you have to be a corporation in under state law, but you could be an LLC. You have to be a company of some sort. So you could be an LLC and choose to be taxed as an S corporation. You can be just a single owner as well and choose to be taxed as an S corporation. And a lot of those PCs that I showed you on Tuesday, the professional corporations, a lot of them are, even if they're just one person, they choose to be taxed as an S corporation. So it is, I said, it's not a legal entity, it's a tax entity. So you make an election to become, once you're a corporation, you make an election to become an S corp. And you do that with the IRS. The tax returns for S corporations are due on the 15th day of the third month after the end of the fiscal year. So this is March 15th, same day that the partnership returns are due. Remember, this is a pass-through entity. So the S corp itself doesn't pay income tax. They pass through the income to the owners, who are shareholders in the S corporation, so that quicker deadline is to give the owners time to get the K1s and then file their own personal returns. You can have up to a 6-month extension on filing that. Corporation has to affirmatively elect to be taxed as an S corp. In order to be an S corp, they have to be a qualifying small business corporation that meets all of these requirements. So they have to be domestic. Can't have foreign corporations that are S corporations. They have to have 100 or fewer shareholders who are all individuals, estates, or certain trusts. So you can't have another corporation own an S corporation. You can't have a partnership own an S corporation. Individual shareholders, a married couple, if both of them own, they're considered to be one shareholder. So really, you could have up to 200 individual shareholders if you had 100 married couples and they both were shareholders. That's okay. They can only have one class of stock, so no special stock. And all of the shareholders have to be U.S. citizens or resident aliens. So you can't have any foreign individuals who own shares in an S corporation. So there are quite a few restrictions. If any of these is violated, like they admit a shareholder who is not a U.S. citizen or resident alien, it immediately invalidates the S corporation status. It no longer becomes an S corporation. Or if you have too many shareholders, all of a sudden you're not paying attention and you get an additional shareholder, now you've got 101, well, you're no longer an S corporation. It immediately terminates the S corp election. The form 2553 is the form that's used to elect to become an S corporation. It has to be signed by everybody and filed on a timely basis. It has to be filed. There is a 2.5-month deadline to file it, and it can be effective the following year. So you've got until March 15th. Let's say you've got a company in 2024. You've got until March 15th to elect to be taxed as an S corporation, March 15th, 2025, and then you can go back and elect to be taxed as an S corp this year. So, but once you pass that point, there are certain instances where you can ask for an exception. But usually once you pass that point, now you're gonna have to wait until the next year. So like if it was April 1st, you could only elect to go back to January 1st of the current year. But if it's before March 15th, you can elect to go back to January 1st of the prior year for that. So that allows you some tax benefits. If it may be a tax savings benefit for that year, if you were a partnership and you determined that it would be a tax savings to be a S corporation, you can actually retroactively do that for 1 year. Once you know what your tax situation is, once you know what the income and expenses are and everything. It is valid until it is statutorily terminated or voluntarily revoked. Statutorily meaning you violated one of those requirements of it. Let's see. They can also choose to voluntarily revoke it. If shareholders owning a majority of the voting stock consent in writing to revoke the election, then it will be terminated. So you need 100% of people to sign off on becoming an S corp, but you only need a majority to decide not to be an S corp anymore. Okay. Let's see. What else? So like I said, it's taxed kind of as though it were a partnership. So it is a pass-through. The shareholders will pay the income tax at their level, just like with a partnership. And there are distributions, just like with a partnership as well, non-taxable distributions as long as there's basis. Basis is important with S corporations, just like it was with partnerships. So you have to keep track of what the basis is. There's no dividends received deduction for S corps like there is with C corps. This is what the tax return looks like. Again, very similar to the C tax return, but this is an 1120S here. Most of the same things. So again, they want to know who owns the business, to make sure it's meeting all of the requirements. This is Schedule K, so remember that Schedule K for the partnership return. This shows all of the separately stated items, or everything all of the K that is going to be on all of the K1s is summarized here on this Schedule K. Schedule L, balance sheet, again, per books. Schedule M1, so just like with the corporations and with the partnerships, there is a Schedule K1. The Schedule M2 is a little bit different. This is like if the S Corp was a C Corp at one point, then I think that's what this is for. I can't remember specifically. Yeah, shareholders' undistributed taxable income previously taxed. So, well, this is to keep track of the earnings and profits as well. Here, we don't go into the details on that. Don't worry about that. Let's see. So here's an example. We got Pitt Company as a S Corp with 2 shareholders. They own 60% and 40% of the corporation. During the year, Pitt has income of $50,000, which includes $3,000 of dividend, $1,000 of charitable contributions. Their S Corp, their S taxable income is $48,000. Pitt's S taxable income is $48,000. I don't know what that means. I thought it said it was 50. Oh, total income. This doesn't, maybe I'm looking at this wrong, but I don't know where the 50,000 came from. Pitt has income of 50,000. 3, 4, 48. I'm confused. All right. We'll say it's 48 because that's what they have up here. So Tamar gets 60% of that. Zeke gets 40% of it. I'm going to assume their math is right on that. I don't know. Dividend income, just like with the partnership, right? And then it gets divvied up between them and goes on their K1, and that's what they report. So Sub S shareholders are taxed on their proportionate share of income and separately stated items, not taxed when they receive a distribution. So just like with a partnership, as long as there's basis, you're not taxed on that distribution. They receive a K1 from the corporation with ordinary income and separately stated items as well. The basis in their stock. Now, S Corp owners own stock in the company. The basis in their stock is adjusted by these items, very similar to the partnership, how that basis is calculated. So it's going to increase with net income. It's going to increase with separately stated income items. It's going to increase with any additional contributions that are made by the shareholder, any additional amounts that are contributed to the corporation. It's going to increase if the shareholder makes a loan to the corporation. That increases their basis as well. It's going to decrease by losses, separately stated expense items, and any distributions from the corporation. Can't go below 0, again, in basis. Any excess goes first to reduce the basis of any loans from the shareholder to the corporation. If any remains after that, it's suspended. So it just kind of hangs out there. So you don't get to take any losses until you increase that basis in the future with more income or any of these other items that may help. So increases are allocated, increase the basis of the shareholder loans, eliminate suspended losses, and then increase the basis of the stock for the remainder. So here's an example here. So Thangam owns stock in an S Corp. End of 2022, tax basis of her stock was $2,000. She had previously made a $1,500 loan to the company. For 2022, her share of the loss in the company was $4,500. So to account for this loss, she's going to reduce the basis of her stock to 0. So then her stock is now at 0, and this is so that she can take this loss. Now it's at $2,500. Then she's going to reduce the tax basis of her loan to 0. So that $1,500 So now she's down to $1,000. And then she would have $1,000 suspended loss. So it doesn't affect the basis of anything, but it's just out there hanging until, and this is why every shareholder in an S Corp, when they get their K1, they get a basis calculation as well, so that they know where their basis stands, and any of those suspended losses would be listed there on that basis calculation. In 2023, her share of net income was $3,000, so that helps to increase her basis back up. She's gonna first increase the tax basis in the loan, which was $1,500, so now she's got $1,500 left. Then she would eliminate the $1,000 suspended loss, so now that's gone, and then she would increase the tax basis of her stock by $500. So next year, if they have a $500 loss, she could take that loss. So it just kind of keeps going on and on like that. What else? I don't know if I want to go through that one. Again, there's an M1 for the, works just the same as the other M1. And that's S Corps. I mean, there's a lot more to S Corps than just that, but just kind of a little intro. Questions?